Hello and welcome to another edition of Focus on Alternatives, sponsored by ADISA. I'm Damon Elder, the publisher of the DIWire.com, and today we're joined by John Good, CEO of NextPoint Storage Partners. And as you probably can guess, we're going to talk a bit about storage investing. So John, why don't we start, in the last decade or so, we've really seen the emergence of storage as a preferred real estate asset class, both among institutional and retail investors. What has led to its emergence, and where do you see it going from here?
I think there are several things at work. Number one, Americans can't get over their insatiable desire to keep things forever.
Oh, you've met my wife.
So, and mine also. So I think that as we keep accumulating, as houses get smaller, there is a need for a place to keep those important things, whether it be records, whether it be antiques, art, wine. Wine's a new area. And I think that has driven a large part of the demand. The other thing that's driven demand is just familiarity with this as an alternative way for people to keep things, kind of the out of sight, out of mind phenomenon. You can go rent a storage unit and give them a credit card and never have to think about it again until you get tired of paying the bill. So I think that awareness of self-storage has increased dramatically over the years, as well as we've just accumulated a lot more stuff in the last number of years.
Plus, from certainly in a retail investor perspective, they tend to like to invest in things that they know and understand, and an awful lot of us rent storage facilities.
That's right. It's stable for an investor. Whether it be an institutional investor or a retail investor, you have an element of very stable cash flow. Storage facilities lease up, and they tend to stay leased up. Even though you have high tenant turnover, there's always somebody else to rent a storage unit when one person moves out. The other thing that you've seen, particularly over the last 3 or 4 years, has been dramatic appreciation in value of storage facilities. Storage at one point in time was a stepchild, if you will, of the main food groups of real estate, and as this awareness has evolved, and as people have begun to utilize storage more and more, and occupancy rates have gone from what traditionally was a low 80s occupancy rate up into the 90s. Institutional investors view that as stable as multifamily or single family rental or other types of real estate, and the cash flows are very predictable.
Now, on the other side of the equation, you really don't have excessive costs to operate these facilities, right? I mean, there's no TIs, no leasing commissions.
It's very much like if you go back 27 years or so, point in time where REITs started keeping records of institutional real estate performance. Self-storage is very closely correlated to multifamily, and if you think about it and compare it to things like office, retail, in some respects hotel, CapEx is dramatically lower in the shorter term rental property types, and in storage it's arguably the lowest. I think maybe certain industrial warehouse could be a little lower. But for the most part, you don't have any CapEx other than roofs and parking lots, and occasionally in the newer product, elevator maintenance.
Well, let's talk a little bit about the newer kind of developments and the need for these elevators. One of the things we're really seeing in more modern development with self-storage facilities is vertical development. Why are we seeing this? What are the benefits?
Well, I think there are two things at work here. Number one, people who own and operate storage facilities have realized after a number of years of doing the opposite that locating your facilities close to population density is important. So facilities have tended to be built in more urban core locations than they used to be. And the other factor at work in that dynamic is just absence of land. Land in top 25, top 40 MSAs in the United States is scarce, particularly in the urban core. And so the only way to be able to deliver the amount of square footage that the market needs is to go vertical.
The more densely populated areas will require more densely populated storage, right?
That's correct.
How would you describe, what are we seeing from a performance perspective in the sector right now? I mean, what's the health of the storage sector?
So the storage sector, along with possibly multifamily and single family rental and data centers, has been one of the top four best performing sectors over the last 18 months, really since COVID began. Interestingly, April of 2020 was the worst month that the storage sector has ever had. People were at home, they were frozen in their tracks, nobody was moving, nobody was comfortable leaving their homes, and we saw rentals drop off the map. Since that point in time, since probably the 1st of June of 2020, self-storage has had the best run it's ever had. Occupancies have gone from pre-COVID, 92% on average, up to 96 to 97% over the last 18 months. Rental rates, which were very soft going into 2020 due to new development, have gone through the roof. Development has largely stopped because of COVID, and people are filling up the vacant space, absorbing the space that was available from the last development cycle. And rent growth now is stronger than it's been in any period except the period immediately following the Great Recession.
Well, that's interesting. That's something I wanted to bring up, that I know there's been a lot of development, as you said, a lot of overdevelopment in the storage space. So COVID really kind of cured that, and now we've gotten more to an equilibrium?
I think we are at a much more equilibrium point than we were at the beginning of 2020. The beginning of 2020, in a number of U.S. markets, we were oversupplied. Since that point in time, construction has largely stopped on self-storage facilities. Now, there's a pipeline out there, and I guess there's a chance that that pipeline will be built in 2023, 24, and 25. So we could see supply pressure again in the next 5 years. But for the next 18 months or so, everybody in the space feels pretty comfortable that occupancy levels are going to stay at their current high levels, and we'll continue to have pricing power and the ability to push rental rates.
Well, speaking of COVID and its impact on the sector, we've seen during COVID housing values across the country have really just surged. What kind of impact is that having on the storage space?
So in the storage space, pre-COVID, there was very little transaction volume because the only thing that was for sale was lease-up inventory, properties that were newly developed. People were afraid that they might not lease up, that they might not hit pro forma. So there was very little trading, and that was trading at cap rates generally 5.5% to 6%. Recently, we have seen lease-up portfolios sell at sub 4% cap rates. So you've seen a 150 to 250 basis point compression over the last 19 months.
Wow, significant. So looking ahead, we're starting to emerge, it seems, hopefully, from COVID. We're getting back, hopefully soon, into a post-COVID environment. Things seem to have settled down quite a bit, and hopefully will continue to do so. Long-term, mid-term to long-term, how do you see the space? What's storage going to do in the next 3 to 5 years?
If you look at storage historically over that 27-year period that I referred to a while ago, it has been the best performing real estate sector over that 27 years. There's a reason for that: predictability of the customers, low CapEx, predictable cash flow, and now acceptance by the institutional marketplace. So there's no reason to believe that as an investment type, as an investment real estate type, that self-storage is not going to continue to lead the pack relative to all other property types.
So it's safe to say you're bullish on storage?
Very bullish on storage.
It's a good thing because you specialize in storage, right?
I specialize in it, and hopefully we'll be doing it for a lot of years to come.
Well, like you said, the numbers don't lie, and it's certainly been an extraordinary asset class for investors over a pretty long period of time now. Well, John, thanks so much for joining us today and for sharing your wisdom and insights. And thank you for watching. For all things alternative investing, please remember to visit www.adisa.org.